Thank you very much, Peter, and thank you for having the panel on here. So this is indeed a little bit different from the other panels in that this is an area where we don't have a lot of regulation, right? The conference is on regulation. It's also often not financial information. So what we would like, what we are hoping to sort of get out of this is that we would like the discussion to be something that will help you as an accounting researcher, either in terms of doing research in this area or maybe in terms of teaching. The panel has been put together in such a way that it sort of goes full circle, as Eugene said before. So we have both users, we have somebody that's heavily involved in producing information, and then we have a standard setter. And of course, I'm on it as well, and most of you know I'm not really doing sustainability research very much, but I wrote, together with Christian and Lucy, a report on economic analysis about what would happen if we mandated sustainability or CSR disclosures. So, and we reviewed the literature for that, so that's sort of why I'm moderating it now. So let me just very briefly tell you about the composition of the panel, but then I'll actually let the panelists themselves tell us about their role and how sustainability affects them. So first we have two users here, Bonnie and Gerben, that sort of are on the investor side, although Bonnie, you're also a little bit, very involved actually in reporting, right, for Invesco as well. So slightly different angles. I'll let them talk about that themselves, how involved they are. And then we have Sonny, that's basically working on advising firms on the production side, so creating these CSR reports. And then, of course, Jeff here in the end is the chair of the standards board of the SASB, the Sustainability Accounting Standard Board. So let me start with you, Bonnie. Can you tell us about how you're involved with sustainability at Invesco?
Sure. So I essentially serve as a consultant and advisor internally to not only our investment teams, really across the globe. So I spend, as you can imagine, large amount of time on the road. We actually have 13 investment centers offering different types of asset class strategies in a number of different regions. And so there's really two components to this. I think Invesco's in a very unique position because not only are we a publicly traded company with responsibilities in terms of enhancing our own corporate disclosure, ensuring that our practices, quite frankly, are truly culturally embedded, but the other aspect of it is the asset stewardship component. So I do have a team across the globe. I've just recently hired a climate expert who's our head of responsible investing in Europe. And joined us from the CDP. So really continuing to build what I would call the expertise within the global responsible investment practice has been important. Now, how I work on the corporate side is quite interesting because we really believe that is a unique synergy. So the fact that we, what we are being held to in terms of standards as a publicly traded company will, ultimately also we could use the expertise from our own investment teams to help drive that. What are some of the key things that they're really focused on as investors, and what are they holding their own portfolio companies accountable for within their portfolios? And so effectively, I work as well with our own corporate counsel. In this year's, for example, proxy filing, I was responsible for ensuring that any of the sustainability data that was included there, again, liaising with head of community relations, our global health, safety, and environmental manager, really reflected, again, Invesco's corporate stewardship stance. And so we really believe, this is really just global stewardship, essentially. And so that's effectively how we've continued to operate. We believe, again, it's a huge synergy for the firm to operate that in that function.
Excellent. Yeah. So Gerben, you're also a user, but you're sort of more a traditional investor. You could think right of a big pension fund, not specifically focusing on sustainability. But can you tell us about how it still affects you, these issues in your investments?
So I'm Gerben de Swart. I'm responsible for all the systematic or quant investments at APG. And let me start with the ambitions of our clients. So in 2016, they have become very ambitious from the perspective of responsible and sustainable investing. So basically, their mission is a sustainable or a good pension in a sustainable world. And we do that for a lot of people in the Netherlands. So about 1/3 of the Dutch population is participants in our pension fund schedule. And we only invest on behalf of 4 Dutch pension funds. So it's the Civil Servants Pension Fund, the Building and Construction Pension Fund, and 2 smaller pension funds. But the ambition they have is within 5 years to lower the carbon footprint of the investment portfolios by 25%, to double the assets related to the Sustainable Development Goals from 29 billion euros up to 58 billion, only to invest in companies that behave well, related to environment, social, and governance. And the simple one is to exclude specific products like tobacco or nuclear weapons. And the question I get very often is, what's the impact on the risk and return? And that keeps me busy on a daily basis. So it's constantly balancing between the return, between responsible investing and the risk. And that's what we balance, and that's basically how we look at each individual investment case. And my team is doing that on a quantitative basis, factor investing or asset pricing. So we use a lot of the accountant data that you're very familiar with, but we consume an equal amount of data on ESG and sustainability to incorporate that in the strategies as well.
Excellent. So, Sonny, you're on the other side, right? Sort of helping firms report. So, what's your role, and how do you do that?
Well, first of all, good afternoon, ladies and gentlemen, and I'd like to thank you, Hans, and Jeffrey and Peter for hosting this event, and thank you for having us here. I think you asked the question, how did I get here, or how did we get here, and what do we do? I got here by accident. I spent 15 years at PricewaterhouseCoopers, over 10 as a global managing partner and the chief strategy officer for the firm at Pricewaterhouse, and then ran a couple of global businesses. I couldn't spell sustainability. And the transition was quite interesting. In terms of what we do as a firm, Accountability is a firm that has been around for 25 years. It was formed as the Institute for Social and Ethical Accountability for England and Wales 25 years ago. So it's gone through a few transitions. What we do is basically, we're an advisory and a standard-setting firm that focuses exclusively in the area of sustainability. Our typical clients are Fortune 500 clients, governments of certain states, and multilateral organizations, the World Bank, IMF, UNDP, etc. And we work with them in 2 ways. Obviously, when you get a phone call, if someone has spilled some oil or someone has had a bad trade, that's a different kind of work. But the better kind of work is the more proactive work, where you help companies work on developing strategies, putting these strategies in place, putting in a balanced scorecard with metrics, putting in programs that they have in place. And it stretches entirely across the E, S, and G spectrum. And one thing to keep in mind, it is very much an idea whose time has come. I was a skeptic. And a lot of friends from my investment banking world, the strategy world, joked at me that I was going to atone for my sins now that I had performed 15 years of them. But I've been a careful and a deliberate convert, not to the point that I still drive a Prius or anything of that sort. I still drive 12-cylinder vehicles, and I love red meat and red wine, but I think there's a balance. It isn't about not making money, it is about making money responsibly, and there's a difference, right? And it's very interesting when you look at it, the pressures. I think there was a survey that was done recently by Deloitte. It was called the Deloitte Millennial Survey. Almost 90% of millennials consider the success of a company in more than just financial terms. So those are your employees of the future. When you look at consumers, over 80% or 81% of global consumers want to make informed choices of buying goods and services that are more than just a functional acquisition. This was an Accenture survey. And they want to make a difference. I just gave a talk at MIT Sloan School, my alma mater, and we went through the Career Development Office and their statistics. And it's been over 20 years, so it was pretty depressing for me anyway, 20 years later, to see them. And and you looked at the top 3 reasons why young women and men want to join companies in the future. Number 1 was we want to work for a company with a purpose. Number 2, there was a multiple choice. It was just a tick mark. Number 2, we want to work for a company with values. Now, guys like me used to say the most valuable company in the stock market, and that's the one I choose, but it was values. And the third one is something that a lot of us in this room can testify to. It was something I hadn't heard of before. It's called, Peter, work-life balance. What's that? Right? So this is how the world has changed, and we help in advisory services and standards. Our standards are more like principles. They're industry agnostic. They can be used by a wide variety of industries, organizations of different sizes, different principles around stakeholder engagement, assurance of non-financial information, and standard principles.
Excellent. So, Jeff, what about you at SASB? I mean, how do you do it? What's your mission? I mean, you're specifically about reporting, right? Reporting information.
Yeah. So at SASB, what we're trying to do is be a private sector market-driven solution to helping companies improve their communication with mainstream investors. And those of you who know me know that I've had a long and deep interest in working with the Financial Accounting Standards Board, and I'm very supportive of their conceptual framework and the efforts that they do. And I think that we've done a great job over the years in developing a system that helps us to account for the assets and liabilities that meet the definition of something that you have or owe today and how that changes from time to time. But more and more we're seeing that investors are making decisions on a lot more information than just that. And so just beyond the boundaries of what you have or what you owe today are the risks and opportunities of tomorrow, and what those are likely to be industry specific. And so in order to facilitate communication there, we have gone through a process that we've mimicked after the fine models that we have for accounting standard setting. So we have a foundation and a standards board, and the standards board is independent from the rest of the organization, so we're not involved in the product development and IP stuff that we do. Or we ask for donations. Feel free to donate to SASB, but I normally, it's not my role to raise money for them. So we have an independent board that reviews the work of the staff and votes on it. And the way that we approach it is to say that in the same way that you need, investor would want to know about the balance sheet and income statement and statement of cash flows for a company, they also have other things that they need to know about when making capital allocation decisions and when deciding how to vote the shares that come with if they happen to be equity owners as well. And so that's kind of like that stewardship notion as well. And so what we do is we carve up the world into, you'll hear a lot of acronyms in this space, unfortunately, but when we think about environmental, social, governance type issues, ESG type issues, at SASB, we're not a one-issue organization. We don't just care about, say, carbon emissions. We care about environmental issues broadly, so pollution, that could be water pollution, it could be air pollution. We care about human capital issues, so how is a company managing its needs with respect to its workforce? We care about also the social capital issues as well, so think of that as like less internally facing and more externally facing, so the health and well-being of your customers and how your views, your reputational capital that you have. So we have 26 categories that we think about, and we try to look at each industry's business model, because ultimately, if it's going to relate to what the business does, that's one way that you can split it up. And so if you do the math, 26 issues by 77 industries is a 2,000 by 2 matrix. And so we develop standards that look at that. And we don't say in any one particular industry that everything matters or nothing matters. And when you look at our materiality map, there's really no issue that matters to all industries, even something as pervasive as around climate change. So we end up developing 77 standards. Those standards identify 5 to 7 topics typically of the 26 that are most likely to be of material interest to investors, mainstream investors. And then we also provide a series of KPIs, so key performance metrics, mostly 75% are quantitative, quarter probably qualitative, that help to support performance reporting on those topics. And so the development of that took, we've been working, the organization was founded in 2011, and I've been involved with them since the beginning of 2013. But it is an extraordinarily complicated thing that we do, but part of the idea is that by taking on a complex task, we can sort of push through to simplify it for others, and so make it easier for investors to be able to think about in any one industry, is a topic likely to be material or not? This is a starting point for having a conversation with a company about particular topics, and also helps companies to resolve that as well. Again, we don't want to be the ceiling for what reporting looks like, but it certainly could help to facilitate communication by providing a starting point and a common benchmark when you're thinking about two firms within the same industry. One thing that I've heard from companies is that those that are involved, like in Bonnie's role, the production of a report, I've heard examples where they've gone to their CEO and said, like, here's our report on our performance, our sustainability performance, and the CEO says, great, are we doing better or worse than our peers? And they, it's hard to answer that question if your peers don't report or report in a different way, and that's a constant challenge in an emerging area like this. But I'll stop there.
Excellent. So, so exactly as you were pointing out, most of it is voluntary reporting, right? We don't have a lot of regulation, but that's exactly where we as academics could potentially maybe do some research and inform the debate and maybe also practice. So when we worked on the report, one thing we did was we tried to analyze what firms are actually reporting. And we found that it seemed to be sort of even within the same industry, it was very different topics, right? And the topics are also very different. So I'm curious now to see what do you think about the current state of reporting? Do you see a trend better, or is it going in certain directions? What information are you using maybe? And also, what is the problem based in assessing what a good firm is, right? So I'll start with the users again. So, Bonnie.
So when we're thinking about reporting, I mean, one of the things we do on the asset side is we actually publish an annual stewardship report. So effectively what we do, and we're actively voting on every single meeting. We've democratized our voting approach. We're actually one of the few firms, asset management firms, that actually have an investor-led, investor-driven model around voting and exercising voting rights and active ownership. Which is very unique. As you can imagine, it was interesting getting fund managers to finally take adoption of the actual voting rights. But I think if you position it as your greater influence in the marketplace, ultimately can be a key driver to really unlock additional returns at the portfolio level. And in fact, there's a really great research paper from Alroy Dimpson and Dr. Ozan Karakis, whom I work very closely with at Cambridge Judge. And one of the things that has actually come out of that is the fact that successful engagement and exercising voting rights and really driving companies to change practices can ultimately unlock up to 7% abnormal yearly returns, which I think is pretty significant if you think about the impact, right, of just really exercising active ownership influence. When we think about reporting, again, from an asset management perspective, one of the things that we're doing is, again, as part of the stewardship reporting, is as well developing ESG reporting, conducting analysis on a number of our different funds. So similar to what we've done on the voting practice side of the house, we also believe that ESG integration has to be part of the investment process. Several firms have established what they call their centralized ESG analyst team, and these ESG analysts have never managed money and are, quite frankly, disconnected from the investment process. That effectively serves as overlay. That's not ESG integration. So one of the things that we set out to do very early on, and it was interesting, I'm going to sort of hit on something that Jeff had mentioned earlier, where the CEO and the senior managing directors always say, well, what are our peers doing? When we were establishing our strategy early on, I got that same question, well, what are our peers doing? And I said, I don't really care what our peers are doing. If we want to be a leader, we actually have to, they're all going down this path. I actually don't believe that's where the market's headed. I believe that we actually need to move down this path. And ultimately, that's really led us into a very good position, because authenticity, I think, is one of the key points that we need to stay focused on here. And as part of that, there's training and education that has to take place at the investment team level. But investors have never needed corporate governance analysts to help support their how they view, for example, executive remuneration or the efficacy of a board. Why would an ESG analyst now be necessary to help train investment teams? So ultimately, my vision for the future is that ESG analysts will effectively go away. And the reality is you don't need an ESG analyst. You need a good analyst at the end of the day. And this can culminate into a lot of different things. So again, you've got a portfolio level analysis that has to take place. There's a number of different reporting, both internally as well as externally to clients. That's going to be significant. You do have to be very transparent in terms of how you're voting and activity that actually occurs there. I know as we heard from Commissioner Jackson just recently, and I met with Commissioner Roisman actually Monday of just this last week as well, separately on voting. It's a huge topic, so in terms of how that's actually going to be managed and regulated moving forward. And then on the corporate side of the house, it's really ensuring that practices align as well with your statements. I think we've seen a lot of asset managers come under fire as of late because there's been a huge rush to the marketplace with what I would call ESG product. And what we've seen with a lot of this ESG product is it's been driven by commercialization opportunities. We've actually taken a very different approach at Invesco. So we have not rushed to market with product, and that's deliberate because we believe that really broad-based ESG integration is going to be fundamentally the future, so that any fund that you're looking at our firm will really be able to describe and actually tell a story around sustainability, which we believe is going to be very, very fundamentally important. So again, the disconnect from the investment process is fundamentally a systemic issue in the industry, and we believe that ultimately that's going to have to change. SASB standards have provided us a great materiality mapping system. I met Jeff at the World Economic Forum, which is why I'm here today. We do participate, as does our CEO who attends Davos each year. And one of the key things is really with fund managers is just really arming them with the appropriate tools. So to the degree that you can really stay focused on materiality, the reality is sustainability is all about investing, and it's all about investing with a returns focus in mind. So if you're focused on material issues, you're ultimately going to drive returns, better risk-adjusted returns in the long term. And so the conversation is really not a divide from fund managers. I think fund managers fundamentally think of sustainability as what I would call pre-2004 SRI. These topics and terms are still interchangeably used. But in 2004, when the IFC and the Swiss government and the UN came together, there was a distinction between ESG investing, which again is just what I would call a broader lens around investing. It's all about better investing and good investing, because you're then effectively taking not only traditional fundamental risk factors, but also your idiosyncratic risk factors and painting a holistic picture. So with that, I think I've probably taken enough time, but just...
Well, I would like to just ask you one concrete question,
Yes.
on same Gerben. But where do you get the information? How do you figure out if your fund managers are making an investment decision? How do you get information? Is it a CSR report? Is it how would you figure out what is a good firm versus not a good firm?
Yeah, so many times corporate disclosure will tend to fall short because, again, we operate in multiple markets, right? So if you're looking at emerging market disclosure, sometimes that's going to tend to fall short. Although I will say, India actually has higher disclosure rates than the U.S. and the UK. So it's interesting when we look at corporate disclosure. Sometimes there's a fundamental misconception that EM is actually behind when in fact it tends to be well ahead. Japan as well has almost 100% strong corporate disclosure. But one of the things I would say there is that we do leverage multiple ESG research providers. Because we're democratized, we believe that, not just leveraging one provider is important. So Sustainalytics is our global provider, but we actually leverage a number of different providers. So if I have an investment team, for example, in Frankfurt who says, you know what, Sustainalytics isn't really serving our needs, then we're going to go ahead and leverage Vigeo. And so it just really depends on fundamentally where our teams are, but our teams effectively drive that. My team conducts the due diligence, helps provide the training, the methodology, effectively how should we leverage this. We use it as a signal and only a signal. There is a tremendous challenge with ESG research in the marketplace today. It's, from my perspective, quite biased in a number of different respects. You've got sector bias, you've got analyst bias, you've got cap range bias, and so you need to really go in with sort of both eyes wide open when you're looking at research. So we can use it as a signal to identify where areas may exist for fund managers, but we encourage every fund manager then to develop their own proprietary view of, for example, credits that they may be, managing an investment grade. And so our global fixed income team now has done that research across 1,200. It's taken them several years to do so. But they have their own proprietary analysis scoring system. So we start with ESG research as providing sort of the initial signal, but we encourage our fund managers to apply their own proprietary view. That's actually the only way that you fundamentally get to what I call true integration and not just window dressing. And let me just add this as well. I have told several asset owners in the marketplace, because I obviously have a very different perspective when I say we don't need ESG analysts. As you can imagine, ESG analysts don't really like to hear from me. But one of the things that I think is really important is as asset owners go through, manager selection processes, if you're talking to an investment team that can't have a sustainability discussion with you without their ESG analyst, that's fundamentally a problem. That means they're not doing it. There's too much of a reliance on an independent third party who's actually not part of the investment team. And so there's truth in advertising here, and I think it's important to draw that distinction.
Just for the audience that may not be as familiar with some of this ecosystem. So there are, in the same way that there are credit rating agencies, and then there are research reports that are written by equity analysts, and they make buy-sell recommendations, or they rate the debt, as AAA or whatever. The ESG system is out there, and so there are a number of companies that have a business model to sell information, basically views and reports around and ratings of companies' performance on a number of different dimensions. And so ESG analysts work for those entities, and they also work in-house as well, people that are particularly focused on that. And some of their data comes from what companies report. Some of their data comes from other types of surveys that are put out there, and just tell us, answer this question for us. And there's real questions like where their data comes from, actually, sometimes as well.
Okay, go very much.
I think Bonnie touches upon something very interesting. So my perspective is the asset owner perspective. So basically, we both have investments internally and externally. And the full ESG integration is on a holistic basis across the full portfolio. So it means that the standards are equal for our internal investment strategies and our external strategies. And we moved that hurdle so far that, for example, to measure the carbon footprint, we supply our external managers on a weekly basis with a data feed for 10,000 listed equity companies with the carbon emissions of each individual company. We provide them the methodology, how to measure the carbon footprint of the portfolio, and in the investment agreements, there is, apart from a performance target, a risk budget, there is a carbon budget for the external manager. So they have to manage the portfolio within a carbon budget. And in that way, we can ensure that we have a consistent and holistic approach across the full portfolio. And I think this shows that data is the key asset to get ESG and sustainable investing working. So you need to have proper data, because what gets measured can be done. And that's why I'm pleased to be in this panel, because that's the big interest of investors. And that's not for one company, but it's for example, all equities in the MSCI IMI, about 7,000 companies, all corporate bonds, another 3,000. So basically, we cover within our internal systems 10,000 different companies, where we say, apart from carbon emissions, this companies behave well and this company doesn't behave well. If a company is not a good company in our opinion, we can start an engagement, and that's where also the portfolio managers get into play. So it's not something that's done by the ESG specialist, and even not on the quant side. So my background is in mathematics, and together with an ESG specialist, I'm speaking or engaging with 2 companies in Israel. Some of the people in my team are speaking with other companies, so really hands-on, we know how difficult it is to engage and to get something done in a company. We have successes in our company. For example, we have suggested some changes to Royal Dutch Shell, but it's hard work. And importantly, it should be done across the full investment portfolio. And to ensure that will be done and it's auditable, it can be audited. We have a knowledge management system where each engagement ask will be documented and the progress with each contact with the company will be documented as well. So in the end, data is driving everything. And apart from the behavior of companies, the carbon footprint, our biggest challenge have been identifying companies that contribute to the Sustainable Development Goals. And that's where we have used big data and machine learning to use financial statements to scrape websites, to identify which company produce goods and services related to the SDGs and which companies don't. So that's a very interesting area. Because of the lack of information, we just had to become very innovative and engage with techniques like natural language processing on 10K filings.
Yeah, and one of the things, excellent point. So one of the things I would add there is corporate disclosure, I think, will always generally fall short. This is where active management really comes to play, right? This is where an investor will engage with a company. They're the ones that are conducting on-site due diligence. They're the ones that are driving discussions with management. And quite frankly, in our case, always driving discussions with members of the board as well. So this is where you uncover what I would call really valuable information is through direct dialogue and engagement, but it does have to be investor-led and investor-driven, because quite frankly, companies are not responsive to me or to an ESG analyst. They're going to want to hear from the person that actually has a 5% holding in their company. That's how you're going to get really active, direct dialogue and constructive dialogue from our perspective. So it's got to be very based on outcomes-based engagement. And so, from my perspective, I think that's really where active management distinguishes itself and can truly uncover what I would call meaningful details, because corporate disclosure as well will tend to be stale. I mean, there are things that play every single day, and these are the types of things that fund managers fundamentally have their finger on the pulse of companies all year round, versus just the annual report or the ESG rating report.
Excellent. So when we as researchers are trying to study like the effect of CSR, yeah, I'm gonna, exactly. We're doing that, we typically looking at this setting, which is like it's a lot of voluntary reporting, right? So I was actually wondering if, certainly add in on everything, but like, can you tell us something about what's driving the choice? Because of course, as researchers, we are we want to know the effect of disclosure, but why do companies choose to report on these issues?
Well, yeah, I'll get to that. And first of all, I do agree with what Bonnie and Gerben have said, but I think there's a slight distinction. I think investors drive this debate, but I think there are several other stakeholder groups that have become very vocal and visible and material to this debate. And whether you look at consumers, whether you look at employees, whether you look at regulators, whether you look at media pressure and reporting, so there are other forces that drive this pressure cooker. But clearly, the ESG community and the analyst community and the investment community is paying heed to this. Part of this is where is this going and why, all right? Where this is going, if you look at any sample, if you look at the S&P 500, in 2011, there were less than 20% of companies that produced a form of a sustainability report. In 2018, there are 86%, as of December 31st, 2018, 86% of companies doing that. Now, it has to be for more than just investors. It has to be for a broader spectrum of stakeholders. Similarly, when you look at, and I can quote an HSBC survey, there's a lot of material that all of us have about institutional investors and companies having some kind of an ESG policy in place. But I think the important thing is also, what do they report against? And that's turning out to be a problem. Because when you asked about voluntary reporting standards, in the last 10 years, the amount of voluntary reporting standards have gone up from 10 to 182 across all industries. So what does this mean? This means there's going to be some shuffling in that space. And we predict, based on our work with Fortune 500 companies, helping them improve their ESG performance as such so that they can perform better on these indices, we see three things happening. We see consolidation, we see industry specialization, and we see some sort of, not mandated, maybe a strong word, but compliance as in reporting requirements. in terms of consolidation, there are just going to be 3 to 4 or 4 to 5 big players that emerge out of this flux. SASB, IIRC, TCFD, whether it's GRI, ISO, I'm not quite sure what it is, but SASB looks to be the strongest. And I've yet to collect my check from him at the end of this talk for the endorsement. But SASB looks the strongest. Why? Because when you have 77 industry sector supplements, when you're well-funded and well-organized, it makes a difference. There's a structured approach to the business. So the second aspect of this is after consolidation of these 4 or 5 big players, there's going to be an industry vertical. There are already many existing standards in the oil and gas with IPICA. There are standards for healthcare. There are standards with GRESB in real estate. So all of these are going to have an emergence, but there has to be something called a convergence. And there's been a recent platform that has started, as you're aware of, with Ian McIntosh, called the Corporate Reporting Dialogue. And the Corporate Reporting Dialogue is to find common ground and report in a standardized form to the extent possible with some of these big players in the ESG space. If you ask me, is there one pivot that might shape reporting in the future, aside from all of what we've discussed? I think that one pivot could be the United Nations Sustainable Development Goals. And I'm sure most people, it may be a 50-50 in this room, whether you've even heard of the SDGs. Over 68% of countries around the world have made formal commitments to the SDGs. And over 62% of companies have made similar commitments to the SDGs. And there are 17 of them. There is a prediction that the United Nations Sustainable Development Goals will create a market, create an actual market of over $12 trillion. $12 trillion by 2030, and 380 million more jobs by 2030. And they're focused in 4 sectors: food and agriculture, health and well-being, cities, and energy and materials, right? And that pretty much covers humanity, right? So if there's a single pivot, there's that. Now, why do companies interestingly report more and more? Number one, there are pressures. Number two, there is reputation. Number three, you want to attract and retain top employees. Number four, having a quick glance at your ESG review, to your point, you're absolutely right. You don't need an ESG analyst. You need a good analyst. You need a great analyst, right? Because well-run companies with good ESG performance probably have good performance in other areas too. And you want the fundamentals covered. So the reasons for doing it are pretty clear. The question remains, there are 2 questions remain. One is the cost of non-compliance. How much is it going to hurt you by not doing it? But the other one was, I had a good conversation recently with a senior person from a regulatory standpoint. And he had some interesting perspectives. I said, let me ask you a question off the record. I said, FASB is a pretty strong body, right? And he said, yeah. And I said, the SEC gave it a nod several years ago, and there was a credibility established with FASB. When do you think SASB is going to get that nod? And he thought for a second, and he said, well, I'm not quite sure. I'm giving you the other side. And this guy's a senior guy. Most of you know him. That's why he'll remain nameless. Okay? And he said, I'm not so sure. And I said, why? He said, well, first, it depends on the tone of the top. It depends on the kind of chairman who's in play. And different chairmen have different points of view. But more importantly, he said, it's a controversial issue, number one. It takes a lot of work, number two. And no chairperson is going to take this on at the risk of tarnishing their legacy, right? So that's a very important concern. He says, well, if Congress runs a mandate and Congress pushes it through, maybe yes. But otherwise, it's going to take an act of God. Okay, I paraphrase him. It's not act of God, but something close to that. So I think that has to be taken into consideration when you look at change, is who's going to be the final tipping point, and where does it come from? Sorry.
So I guess in terms of what we see at SASB and involvement with the outreach that we do to investors and to companies to ask about feedback on our standard setting efforts, I've seen personally that there's, number one, there's just been a huge sea change in interest from mainstream investors. You know, in 2013, 2014, companies were very uninterested in talking to us about what we were doing, but investors were also not particularly interested as well, I would say, and that has changed dramatically in the last 3 or 4 years. And every 2 years seems to be about long enough to have noticed a sizable difference in level of investor interest, investor awareness around this, how pervasive it is, the companies. And you know, just for example, we have an investor advisory group at SASB, and it is comprised of asset owners and asset managers, and it's about 26 or so, maybe 30 different asset managers, asset owner companies, and they reflect about close to 30 trillion in assets under management. It's a big number, and it's because they are supportive of our mission, and they believe that they need better information out there in order to do their jobs. That's gotten the interest of and awareness of companies, and so companies are now looking at this. In the absence of good corporate disclosure on this, to Bonnie's point, there are lots of sources of data that are filling the gap, and that's creating, you know, what's often called survey fatigue for companies. They are getting petitioned constantly to like respond to this request or that request. Tell me. You know, there's an efficiency to a single disclosure that meets broad needs, you know, to general financial reporting standards. And right now we're not seeing that. And so companies are frustrated that they're getting all these requests. They're not sure which ones to respond to, which not to respond to. It takes a lot of time and effort. So there's survey fatigue. There's frustration, you know, again with that data. There's frustration with the ratings that come out of the absence of good information and not understanding how companies can better manage those ratings because they don't know where that information is necessarily coming from. And so what you're seeing is that companies are also getting, I think, more sophisticated about their understanding of these issues. And we're improving a problem with the language, which is that we talk about it like there are ESG factors, but in fact there are business issues that are likely already being managed well within the company, potentially, or, you know, could be or should be, and so it's partly an awareness issue, and so we're seeing de-siloing within companies in the same way that I completely agree. You don't need ESG analysts, you need good analysts. But within companies, you don't necessarily need sustainability functions per se. You need good managers, right? Not sustainability managers within a company, but like, you know, you need good managers. And we're starting to see that, where it used to be a health and safety person or you know, somebody with a philanthropic background that was given responsibility to put out a report to talk about the good that they're doing. Now the responsibility is shifting more, you know, certainly to the, you know, the PR function within the company, but to the IR function as well. And chief sustainability officers now are being promoted within companies to be part of the executive team. They're being asked to understand about the strategy of business and to speak the language of business. And it's all the way up at the level of the directors in companies. The board of directors are now being given responsibility to deal with oversight around sustainability issues. And again, I think this is just because we're in a transition period. At the end of the day, you're not going to have directors who have, you know, oversight over sustainability issues. You're going to have directors that are just, you know, managing their responsibility to oversee the health and well-being of the company. So.
Excellent.
Quick point to what Jeff said, spot on. You know, we've done a survey to see what percentage of chief sustainability officers are either sitting or reporting either directly to a CEO or a member of the executive team. And the number has gone up threefold in the last 10 years. So I mean, there's no doubt about that. Secondly, sustainability is now being incorporated into the DNA of a company, into the process of a company. So pretty much, and I often liken it to something, for those of you who are old enough to remember, there was this whole thing called Y2K, and he had e-commerce departments and e-commerce divisions, and e-commerce is just commerce today. It just became assimilated into the mainstream of the business. And I think that's pretty much the way where sustainability goes, even in terms of, you have audit committees on boards, you have compensation committees, you have nominating committees. We are seeing, you know, again, there's another, as part of the survey, we did over 72% of the global 250 had a sustainability committee or a subcommittee at the board level. So it's an issue probably whose time has come. Sorry for cutting in.
So let's open it up now if there are any questions you would like to ask.
To reach the board level, there's alpha to be made by investing on sustainability information. I mean, are there any disclosure rules? I mean, should the SEC be involved to the extent that this is material information that's affecting the governance of the firm? And, I mean, is there any discussion about that?
So the question is there discussion about SEC oversight on this? I will say, like, at SASB, we do regular briefings with the SEC, and, the commissioners and CorpFin and other departments. And we don't do it seeking for them to endorse what we do. We're trying to be a private sector effort, and with the hopes that investor interest will be enough to drive change in what we're doing. But I would say that I believe that the SEC is interested in a number of things. I mean, there are questions that they are asking around some of these issues, and I think that's likely to change. There's interest in human capital, I think, at the SEC as well, and there's a lot of interest in quality of disclosure across multiple channels, because the siloing that happened before, you could have a report being put out, a CSR report being put out, talking about all the things that they might be doing, and that could be different from what was being disclosed in the 10K.
In particular, I was worried about selective disclosure. And if a board was asked to fill out a lengthy questionnaire about a whole bunch of corporate governance things, that would certainly be a selective disclosure.
So I think one of the so I don't think there's been any challenges around the materiality of that in terms of insider trading based on any of that. And I haven't seen anything like that. The issues that we've heard more about are they've asked what we've seen in terms of cherry picking of disclosure, so more that type of selective disclosure, and so where a company might be applying a framework of their own, another framework that allows more flexibility, or their own framework that they've developed. Those reports, when academics have looked at them, have noted that there's a surprising lack of discussion of negative issues or poor performance on anything.
The kind of questions our boards of our clients have been asked have been pretty benign so far, but they're intensifying in their pressure. So you have things like conflicts of interest, obvious ones, independence. Compensation comes up, but that comes up anyway. It came up before this. And then there are issues that we have that are slightly trickier around FCPA, the Foreign Corrupt Practices Act, anti-money laundering, but you can easily take them to your chief compliance officer and explain that you have codes of conduct, you have guidelines, and you're following the federal sentencing guidelines, so you can get away with that. The challenge starts about when you ask boards about their active engagement, right? Vis-a-vis strategy and the likely impact of the choices that they or their predecessors have made 5 years ago for which the company is paying now. That hasn't happened as yet. So,
you mentioned that the percentage of firms providing ESG reports has, S&P 500 has gone up to 86%. Is that right?
that's correct.
Okay, so, and that was dramatic in a 5-year span.
It was actually in 2011 to 2000.
Okay, so was that, do you think that was a documentation exercise that firms went through, or was it, like, did they actually change their business practices over that window? And how much variation is there in those 86% in terms of, like, really good ones versus people that documented that they're not so good? Like, that's kind of what I'm wondering.
Certainly. Do you work with the Big Four?
No.
Good. So I think you make a fair point, right? The number going up to 86% from under 20 can be due to many, many reasons, right? One is there is more standardization and there are better metrics as they come out. But with better metrics and more standardization, there's increased scrutiny, right? So they go hand in hand. We always advise companies that at the end of the day, more reporting does not mean good reporting or even better reporting. It is reporting on what matters, what's material, as was discussed. when you report the movement of a needle, but very seldom what happens in the boiler room, as you said, in terms of the processes, the systems, and the improved performance of the company. I would say that companies that have been seeking professional help to actually improve their reporting performance have actually gone down and rolled up their sleeves and fundamentally re-engineered the processes that dictated the outcomes, right? And if I hate to give you a split, but it's probably more like 60-40 or 65-35 of companies that have actually done that. The other 35 just have gotten better taking tests, right? I mean, everyone knows that the SAT is not a great measure of human intelligence, but if you don't take that, you don't get into a good college, right? So you figure out a way to go to Kaplan's or Princeton Review or something, and then take the test and.
Or you just buy it.
Enforcement is a separate topic on this panel next year, but yeah. So I would say they have made an attempt. Not all of them, but probably over 50% of them have actually decided because there's only a threshold. You can improve your scores to a point, but then you plateau out if you don't fundamentally and radically redesign and rethink what you're doing, because then it becomes like an exercise of just shuffling deck chairs on the Titanic. It's going to go down.
Okay, so next question.
Thank you. My question is directed to Gerben because he's also managing my pension. So I'm going to apply some active engagement here. You're saying what gets measured can be done. In other words, you say what we measure steers how corporate behaves. So I have two questions. Who defines what gets measured? And if you know that, how do you know that the actual measure is measuring what you want to measure? Sure.
Yeah, so it's true that we manage your pension, so I'm delighted with these questions. The first question was a question that we also raised ourselves in 2016, because the whole challenge, and I think that's also clear from the discussion, there is no consensus definition on responsible investing. So you need some guidelines or some starting points. And luckily, from that perspective, the structure in the Netherlands is that every civil servant has to be with the Civil Servants Pension Fund. It's a board of about 12 people, and they have the final say on what they want. So the ambitions that I mentioned, they are just imposed or agreed upon by the board, and we execute and try to improve on the execution. So again, it's carbon reduction, investing in companies that behave well, and double the assets under management invested in SDG-related activities of companies. And then how do you measure? And that's an interesting question, because since 2016, we are now at 2019, so we're almost by 2020, that was the final year. And that's exactly the question that the board is raising. So what is the impact? So we observe and monitor that your carbon footprint is going down, but what is the impact on the returns of your pension? And that's a good research question. So we have several solutions. So for example, when we invest with external managers, we ask them for the performance of a similar composite, global equity mandate, APG separated with all the ESG angles, and the global mandates managed for other clients, and to just get the return difference. And when we do that across 30 managers, we have some understanding of the impact of that year. So samples are small, but it definitely keeps us busy. And the next, but that's for another time or offline discussion, you get a whole discussion on benchmarking the investors. What is a relevant index to benchmark how good are they doing their job?
I don't think anybody has touched yet on the role of assurance in this process. So there's been quite a lot of discussion about the diversity of measurements that are out there, but what role do you see for the independent assurance of that information?
Well, having come from a background with the Big Four, I think the Big Four had justifiably assumed the initial role of assuring early non-financial reports, but they tended to confine themselves to the environmental, health, and safety areas, right? And they called them the environmental audits, and they added them as a supplement to the overall audit statement. I think you're seeing more and more of the audit firm, and the logical place for them to belong could be the audit firm. But however, the Big Four have not been classically trained to measure, manage, report, or understand these issues, both at a strategic or a systemic level. Interestingly so, the fastest growing advisory practices within the Big Four are the sustainability advisory practices, right? They're the fastest growing. So there is a lot of cross-pollination because of the advisory work that they do, that the assurance or the auditing would be probably provided by similar institutions. You know, the thing is, with a lot of pure consulting firms who advise in this area, they're not interested in assuring statements because it's a very restrictive market. It cuts down the possibility of then advising them, right? So there's a conflict. So you know, if you gave me an assurance, I would say no. I'd rather not. There's much more money to make in consulting. But when you look at a Big Four, it's a different equation because they're looking at different things. Sorry.
So, yeah, I know we have to wrap up very quickly. One of our panelists has to run, Gerben. Actually, two of them. So, but on this point, I would say, like, one of the things I've heard from companies is it depends a little bit on what the topics are. I mean, historically, when the reports were more about charitable contributions, there's a question of do we pay to assure the number of contributions that we give, or do we just give more away, right? And so, but to the extent that that starts to shift to these reports containing information that is about performance on material issues and compensation is being linked to performance on them, then then it may make more sense just to invest in good data systems as well as some degree of external assurance to support quality reports on that. And I guess the other aspect is to the extent that there are standards that have suitable criteria, you can have a higher degree of assurance around that. When it's only a sort of like a negative assurance that can be done, that's going to be of limited value, and so there's less interest in that, maybe to a degree.
Okay, yeah, I'm afraid we're going to have to end now, but you can talk about it in the break, of course. So thanks a lot to everyone.